Well, good afternoon and welcome to HIROC's weekly webinar where we talk about what we see happening in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I'm Scott Tomlinson. My partner and colleague Paul Tepsich, the founder of HIROC, is not able to join us today, but our financial planner and wealth forecast specialist, Bianca Tomlinson, is. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Well, we're going to have a slightly abbreviated call today as it could all be changing in the next 24 hours. But as you all well know by now, our overriding theme for 2016 is that financial markets will remain volatile. It has been a volatile couple of weeks leading up to the U.S. presidential election, but the election results will determine volatility going forward, and we could get a spike in volatility or we could see things settle depending on the outcome. We'll talk about this more in just a moment. And we continue to think that the risk of a recession in the U.S. is high and rising, especially so if the Fed chooses to raise interest rates in December. Inflationary pressures appear to be easing in North America and Europe, but less so in Asia. Extraordinarily stimulative central bank monetary policy on its own has reduced the potential for volatility, but has not succeeded in reigniting economic growth, and now central banks are revisiting their options. The U.S. election has further widened the division in that country. Brexit could have a huge impact on the UK and European economies. Add in threats from Russia, North Korea, the Middle East, and the world looks like a very uncertain place. Well, bond markets are not providing their usual leadership role as central bank policies are in a state of flux. And equity market prices do not truly reflect the underlying fundamentals and remain, in our opinion, expensive. And as I like to tell everybody each week, we are in a time when the risk-free rate of return is basically at 0%. So everything that is an investment with growth attached to it will have some risk. Now, inflation, depending on your circumstances, is at about 2%. So the math suggests that to get better than inflation growth with your money, you obviously need to take some risk. The question is how much and what kind of risk. We think that investors are taking on too much risk relative to the potential returns. Let's have a look at what's been driving markets over the last week. Well, as I said, volatility has picked up heading into the U.S. election. It could go either way from here. A Trump victory will see investors moving away from riskier assets, and that will push volatility higher. A Clinton victory would likely calm markets, but it would also depend on who might control the U.S. House of Representatives. Gridlock is good for the markets because it takes out uncertainty, i.e. nothing gets done. We have continued to immunize our client portfolios as best as is possible from this potential volatility, and it has been a major focus at HIROC based on our expectations, and that strategy has paid off, as you see in the portfolio performance versus the underlying benchmarks. There is certainly more fear with higher levels of volatility. We predicted that fear would return when greed was at its highs, and there could be more fear to come down the road. And each week I will point out that it is important that we know that the broad and diverse global benchmark equity is and consists of a number of, in fact, 2,500 companies domiciled in 23 developed countries and 23 developing countries, and covers 10 economic sectors. We want to have a global focus so as to not be susceptible to what is called home country bias, where investors are under-diversified and take on greater amounts of risk by being too exposed to assets of the country that they live in. It is also important to remember that many of the companies in our benchmark index have a global perspective, so we need to keep in mind that it is the companies that we are investing in, not the countries. Our benchmark index is down a little over 0.5% since we last spoke. UK and European markets have been lower by about 2 to 2.5%, while the US market is lower by just about 0.25% after the advances in the last couple of days. Now, year to date, the benchmark All Country World Index is up about 5.5% over the course of the last year, up just a little over 2%. 3-year returns, total returns, 361, and the 5-year return just over 8%. Bond prices are lower. Our benchmark XBB is down by about 0.75% since our last webinar. Year-to-date total return is about 3.5%. 1 year just a little under 6%, a little over 5% for the 3-year, and about 3.75% for the 5-year return. If you combine the equity and bond indices into a balanced scenario and allow for fees and MER costs, the total benchmark return for a 60-40 bond index combination year-to-date is for a little over 4.5%. 1 year about 2.5%, a little over 3% for 3 years, and 5.17 for 5 years. For a less risk-oriented, less growth, more income-oriented portfolio, 40% equity, 60% fixed income. Year-to-date, just a little under 3.5%. 1 year is 3.25%, 3.40 for 3 years, and 4.30 for 5 years. Now, how does this compare? When we look at the portfolio of a HIROC client who started with us in January and has a 60-40 balance per portfolio, which does include an underweight exposure to equities, recently adjusted exposure to fixed income, and also more exposure to non-correlated assets in our tactical model. The total return this year to date after fees and costs is 6.79%. Now, the combined fully invested benchmark total return after allowing for fees and costs for comparison over the same time period is at 4.58. So our defensive strategy with lower exposure to the equity market than the benchmark and exposure to non-correlated assets through our tactical model has had better returns for our client, lower volatility, better risk-adjusted returns, and a better total return overall. And after fees and costs, the 1-year performance of a 60-40 HIROC client is a 5.04% return compared to the combined benchmark at 251. And the longer-term 4+ year annualized total return since inception is at 780, and the benchmark for the same time period is 486. Now, I must remind all of our listeners that historical returns are in no way a guarantee of future returns, although at HIROC we do work very hard to try to get the best possible risk-adjusted returns for our clients and ourselves at all times. Well, oil is down about 8.5% since our last webinar, just a little above the $45 level, and the Bloomberg Commodity Index was also lower. The U.S. represents more than 20% of the global economy, and with over 50% of the companies in our benchmark index domiciled in the U.S., we do keep a close eye on what's going on there. And as you all know, the U.S. presidential election should be decided today. And as I suggested earlier, depending on the outcome, there could be all sorts of craziness. Most importantly, if it does ratchet up the volatility, our clients should be spared the worst of it. North Carolina and Florida appear to be crucial in the presidential race, and Trump must win both of them. Meanwhile, the U.S. economy expanded at an annualized rate of 2.9% in the third quarter of 2016, more than 1.5% in the previous quarter, and beating market expectations of a 2.5% rise. The advanced estimate from the Bureau of Economic Analysis showed this last week. The increase in real GDP reflected positive contributions from personal consumption expenditures, exports, private inventory investment, federal government spending, and non-residential fixed investment that were partly offset by negative contributions from residential fixed investment and state and local government spending. Imports also increased. As we look forward, the GDP Now model forecast for real GDP growth, seasonally adjusted annual rate in the fourth quarter of 2016 is at 3.1% as of November 4th, up from 2.3% on November 1st. The forecast for fourth quarter real consumer spending growth and real equipment investment growth increased. The forecast of the contribution of net exports to fourth quarter real GDP growth also inched up. Of course, this all could be moot if a Trump presidency happens. Consumers will likely postpone purchasing until they see the dust settle. Now, November 2nd, the Federal Open Market Committee decided to wait for further evidence of economic strength before raising rates, but odds of a December increase of 0.25% stand at a little over 80%. Elsewhere in the global economy, while other central banks are sitting on their hands, waiting to see how financial markets and economies evolve. Where do we see all of this taking us? Well, bond markets usually lead other financial markets, but as I said before, bond markets have been readjusting for the last few months as markets prepare for changes in central bank policy. From the Fed potentially raising rates, to the European Central Bank slowing its quantitative easing, to the Bank of Japan redesigning its stimulus package. Bond markets are confused with an economic scenario that does not necessarily point to growth, but there appears to be increasing concerns for higher inflation on the horizon and uncertain central bank action. It is not clear what this implies for the future, but bond investors are not taking any chances. The result is bonds and stocks have been trading in a more correlated fashion recently. What happens next is going to be a direct result of the U.S. election, financial market volatility, and ultimately central bank response. As for equity market value, over the past 4 years on average, actual earnings reported by S&P 500 companies have exceeded estimates by 4.3%. During the same time frame, 68% of companies in the S&P 500 have reported actual earnings per share above the mean EPS estimates on average. As a result, from the end of the quarter through the end of the earnings season, the earnings growth rate has typically increased by 2.9 percentage points on average, due to the number of and magnitude of upside earnings surprises. If this average increase is applied to the estimated earnings decline at the end of the third quarter of -2%, the actual earnings growth rate for the quarter would be a positive 0.9%. Now, at the moment, with 85% of companies reporting, 71% have beat estimates, and actual plus expected earnings are now at plus 2.7%, and that is well above the average surprise and the first positive number since the first quarter of 2015. So earnings showing some signs of improvement. And why are they important? Well, again, more repetition here, but we do think it is an important, very important, to look at these fundamentals. They are, in fact, the fundamental reason for buying stocks. When investors buy stocks, they buy a stream of future earnings, which go to pay dividends or are reinvested in the company. The price-to-earnings ratio represents one metric to measure stock prices relative to earnings. The 10-year average price-earnings ratio is 14.3 times, and now the 12-month forward price-to-earnings ratio, which incorporates analyst forecasts for earnings 12 months into the future, is currently at 15.9 times. Lower than the 16.4 times that we saw 2 weeks ago, but still relatively expensive compared to historical value. What does it all mean? Well, for over a year now, we've taken a cautious and defensive posture to investing because of our concerns of heightened levels of volatility. That does not mean that we are not investing, but we are utilizing our experience and skill to ensure that our and our client portfolios are invested to achieve the best possible risk-adjusted returns. It is clear that we have been able to not only capture growth, but keep it in times of volatility. Part of the success of our year-to-date returns comes from what we have been able to achieve in our tactical model. We have been active through a combination of intrinsic value trades, strategic trades in energy stocks, and high-yield bonds, and some event-driven trading that came to fruition in early October. This unique signature model has added considerable non-correlated value to our client portfolios over the course of the year. Well, that's it for today's discussion. If anybody has any questions, this would be a perfect time to ask them. All right, no questions today. I'm sure most of you will be spending more time watching the U.S. election results than reading or listening to this particular webcast. However, if you are listening to the recorded version and you might have any questions, please don't hesitate to email them to us. We do appreciate all the feedback that we get. As always, thank you for taking the time to tune in today. Thanks for taking the time out of your busy schedule. Don't forget to tune in next week. But until then, this is Scott Tomlinson signing off.